Welcome back to Talk Tickers, everyone.
Great to be here.
It is February 2026, and the snow is still piling up here in Chicago.
Yeah, the wind is absolutely howling off the lake today.
It really is. But let me tell you, on Wall Street, things are heating up.
Oh, definitely.
We are right in the thick of it right now. The market is currently in this process of digesting just a massive data dump from the agricultural and chemical sectors.
It's that time of year.
Right. It's that time of year where we figure out if the world is going to have enough food and, more importantly for us, who is actually going to make money providing the inputs for that food.
I mean, it really is the most interesting time of the year for this specific sector.
Yeah.
Because you have this uncertainty of the planting season clashing right into the hard reality of year-end financial results.
Right.
And it just creates a lot of noise.
So much noise.
Yeah.
And that is exactly why we are here. We're bypassing the fluff today.
Exactly.
We're ignoring the corporate jargon, the glossy PDF headers, and, all the synergy talk.
Right. The synergy talk is always
a distraction.
Yeah.
We are getting straight into the raw earnings data and what it actually means for your portfolio.
That's the mission.
So today, we are executing a deep dive on a company that sits right at this crazy intersection of global food security, energy spreads,
and really just a masterclass in capital allocation.
Exactly. We are talking about CF Industries, ticker symbol CF.
The nitrogen heavyweight.
The heavyweight champ of nitrogen. Now, if you're casually listening, maybe you're driving to work or you're at the gym right now, you might think, okay, fertilizer, nitrogen. How exciting can that really be?
Yeah, you probably picture a tractor moving slowly across a field somewhere in Iowa.
Right. But this isn't just about farming, is it?
Not at all. I mean, sure, the end product grows corn and we all like to eat, but the business model, it's about geopolitical supply shocks. It's about natural gas arbitrage between different continents.
Which is huge right now.
Right. It's about global shipping logistics. And honestly, it is about a management team that is buying back its own stock at a pace that is, frankly, aggressive.
Aggressive is definitely the right word.
Yeah.
We're going to unpack that buyback strategy in a bit because the numbers are staggering.
Truly.
We're talking about a shrinking share count that changes the math for every single remaining shareholder. But first,
we got to do the vibe check.
Yes, the vibe check, the market reaction. This earnings print dropped, and what did the street actually do?
They bought it.
Yeah.
And they didn't just buy it politely. I mean, they bought it with total conviction.
The stock closed the session following the release at $99.46.
Which is a solid move.
Right. That's up roughly 3.8% in a single day. Now, 3.8% is nice, but the price action tells, maybe half the story.
Exactly. You have to look at the volume to really understand the psychology here.
Because volume is
the truth serum of the market.
I love that.
The 50-day average volume for CF is usually around 2.3 million shares. So it's a liquid stock, sure, but it's usually pretty steady. But on the day of this reaction, we saw over 6.1 million shares change hands.
Wow.
That is nearly triple the normal activity.
So high volume, price moving up. That tells me this wasn't just, retail investors dipping a toe in.
No, not at all.
This wasn't just some day traders chasing a green candle.
Right.
This was real institutional accumulation. This is the big money. Pension funds, massive asset managers moving explicitly into the sector.
Because the market actually liked what it heard.
Clearly.
And frankly, looking at these sources we have, they had very good reason to.
Despite some operational headaches, which we will definitely get to, specifically the situation in Yazoo City.
Yeah, that's a whole thing.
But the street is clearly buying this tight market narrative.
Exactly.
Yeah.
The sentiment shifted from show me to okay, we believe you.
Right.
Leading up to this print, there was just a ton of skepticism. People thought prices were going to absolutely collapse.
But the tone of our deep dive today is going to reflect the constructive reality that the data actually supports.
The bears were looking for a collapse in pricing, and it just did not materialize.
So let's look at the headline numbers. The results, snapshot. CF Industries reported revenue of $1.872 billion for the fourth quarter of 2025.
Which is a massive number just in isolation.
Yeah.
But context is king here. You have to look at what the guys in the nice suits on Wall Street were predicting.
The consensus.
Their consensus expectations were sitting right around $1.78 billion.
Okay.
So they beat the top line by nearly $92 million.
That is not a rounding error.
No, that is a significant beat. Year over year, revenue is actually up 22.8%.
That is robust growth for a commodity player. I mean, usually in commodities you see these massive swings, but 23% growth suggests what? Volume and price are working together?
Exactly. They are firing on both cylinders there.
Now, let's look at the bottom line, because this is where the divergence gets really, really interesting. GAAP earnings per share came in at $2.59.
Right. And the expectation there was somewhere around 2.47 or 2.48.
Okay.
So a solid beat there, too. About an 11 or 12 cent beat on the GAAP numbers.
Which is good.
It's good. That keeps the lights on. But you know as well as I do, the street trades on the adjusted numbers.
Always. The non-GAAP figures.
And that is where they blew the doors off.
What was the number?
Adjusted EPS came in at a massive $3.06 per share.
306.
Yeah.
That is a beat of nearly 60 cents.
59 cents to be precise.
I mean, in the world of earnings per share, missing or beating by a penny or two is standard noise.
Right.
Beating by 60 cents.
That signals a fundamental disconnect between what the analysts thought was happening and what was actually happening on the ground.
So why such a huge gap between the GAAP number, the 2.59, and the adjusted number of 3.06? Like, what are they adjusting out?
It's mostly non-cash charges and some one-time items related to those operational issues we mentioned earlier.
The Yazoo City incident.
Specifically Yazoo City. The adjusted number is really trying to show the normalized earnings power of the business if you just strip out the weird one-time bad luck.
Got it.
And the market is saying, we accept that adjustment. The core business is earning over $3 a share per quarter.
And just to round out the P&L, full year 2025, adjusted EBITDA landed at $2.9 billion.
Which is just an incredibly healthy number.
Yeah.
It demonstrates the cash generation power of this business model, even when, as we'll discuss, everything isn't running perfectly smoothly.
Okay, so they made a lot of money.
They did.
But what did they actually do with it? This is the part of the CSF that I think really hooks people.
Oh, absolutely.
It's the reason you own this stock instead of just, buying a futures contract on urea. We're talking about shareholder yield.
This is the core of the bullish thesis for a lot of long-term holders. Management isn't hoarding cash. They aren't going out and making reckless, expensive acquisitions of completely unrelated businesses.
They aren't buying a software company or a movie studio.
Exactly. They are returning capital directly to the owners.
So let's look at the buybacks. In 2025 alone, how much did they spend buying their own stock?
$1.34 billion.
Wow.
They repurchased 16.6 million shares in a single calendar year.
Put that in perspective for us. 16 million shares sounds like a lot, but what does it actually mean for the pie?
That is roughly a 10% reduction in the total share count.
10%.
Think about that. Like if you own a pizza and it's cut into 10 slices.
Okay, I like pizza.
Right, and you own one slice. Suddenly the chef comes out, takes away one of the other slices, and redistributes the remaining pizza so it's only cut into 9 slices.
My slice just got bigger.
Your slice just got bigger without you doing anything.
That's a massive slice of the pie disappearing from the float.
It is, and it creates this really relentless upward pressure on EPS. Even if earnings just stay completely flat, EPS goes up because the shares, is going down.
Plus, they paid out dividends.
Right. Another $326 million in dividends.
So what's the total?
Total capital return to shareholders in 2025 was $1.7 billion.
It's incredible. And management actually highlighted a metric that I think is really clever. They call it nitrogen participation per share.
It's a great way to frame it.
Yeah.
Because usually you think about production capacity as a gross number for the whole company, right? Like how many tons can we make total?
Right.
But because they've been shrinking the share count so aggressively for years, the amount of nitrogen production capacity that backs each individual share has increased by over 35% in the last 5 years.
So you own 35% more factory, effectively, per share than you did 5 years ago.
Precisely. You own more tons of production.
Yeah.
And what this signals is extreme confidence. You don't buy back 10% of your company if you think the cycle is about to crash.
No, definitely not.
You don't spend $1.3 billion if you think prices are going to collapse next month. You do it when you truly believe your stock is undervalued relative to your future cash generation.
It tells us they believe their mid-cycle cash generation is Robust and sustainable.
Exactly.
Which segues perfectly into why they are so confident. Let's move into part one of our deep dive.
The macro setup.
The macro setup. Management is describing this as a constructive market, which is corporate speak for prices are high and supply is tight.
It's the perfect storm scenario for a producer like CF.
Yeah.
The core thesis they presented, and the one the market had been pretty skeptical of, honestly, was that 2025 and 2026 were supposed to be the years where global supply finally caught up.
Right. Everyone was waiting for the glut.
We were supposed to see a wave of new capacity that would balance the market and bring prices down.
But that didn't happen.
It did not. The market stayed tight. In fact, it actually got tighter.
So let's break down the supply side first. Why is there no fertilizer? Or at least, why is there less than expected?
It's a combination of geopolitical friction and just raw resource constraints. First, you have to look at the gas availability.
Because gas is everything here.
Right. Nitrogen fertilizer isn't dug out of the ground, it's synthesized.
It's made from natural gas using the Haber-Bosch process.
Yeah, exactly. If you don't have gas, you don't have product. Trinidad and Iran are two major global exporters. Both are facing significant gas curtailments right now.
Explain the Trinidad situation for a second, because that used to be a really reliable source for the U.S. East Coast.
It was. But their gas fields are aging.
Oh.
They simply cannot pump enough gas out of the ground to keep the petrochemical plants running at 100%.
Wow.
So they're forced to run at lower rates. And that just removes tons from the export market immediately.
And what about Iran?
Then you look at Iran. They have the gas reserves, sure, but the infrastructure is crumbling. And winter demand for heating takes priority over industrial use.
So people need to heat their homes.
Right. So in the winter, the fertilizer plants just get shut off to keep people's homes warm.
And then you have Europe. I mean, this has been the story for a few years now, but it hasn't gone away.
Europe is the swing producer. They're essentially the highest cost producer. Look at the gas prices mentioned in the call.
Yeah.
They referenced European gas trading in the $11 range per MMBtu.
Okay, for context, what is U.S. gas trading at right now?
Around $3, maybe a tick lower depending on the day.
So let's pause on that math. If you are a European producer, your raw material cost, which is what, like 70% of your total cost?
About that.
It is nearly 4 times higher than your U.S. competitor.
Exactly. So if you are a European producer, you are looking at the global price of ammonia or urea, and you are doing the math.
Yeah.
At $11 gas, your break-even price is sky high. If the global price dips even slightly below that, you turn the plant off. You idle it.
Because you're losing money on every ton.
It is literally unprofitable to run the plant. So production gets curtailed or shut down entirely across Europe.
Plus, you have the looming specter of CBAM, the Carbon Border Adjustment Mechanism.
Right. It's making European production even more expensive and complicated. It's a carbon tax, essentially.
Yeah.
It adds another layer of cost to the European industrial base, which just further entrenches the advantage of low-cost producers like CF in North America.
We will definitely talk about the game theory of CBAM later.
Yeah.
But for now, just know it acts as a lid on European supply.
Absolutely.
And then there's the big wild card, China. We always have to talk about China and commodities.
Always. It's the missing export story right now.
Okay.
Historically, China floods the global market with urea during certain windows. They are the world's largest producer.
Right.
But the management team noted that Chinese urea exports ended seasonally, and crucially, they aren't expected to flood back into the market.
Why is that? Is it a production issue or a policy issue over there?
It's pure policy. It's food security. The Chinese government is prioritizing domestic availability above all else. They want to ensure their own farmers have abundant, cheap fertilizer to secure their own grain supply.
That makes sense.
Export profits are completely secondary to internal stability for them. So those 4 to 6 million tons the world might have expected to hit the oceans.
Yeah.
They aren't showing up. They are staying in China.
So supply is capped literally everywhere. Trinidad has no gas. Europe is too expensive. China is hoarding it. Now let's look at demand. It seems like the world is incredibly hungry.
Incredibly hungry. India is the real standout here. The expectations for Indian demand were around 6 million tons of imports.
And what do they actually take?
10 million tons.
10 million. That is a massive delta. That's almost double what was expected.
It's huge. That is 4 million tons of product that was sucked right out of the global trade flows that nobody accounted for.
Wow.
That creates a massive vacuum. When India buys that much, they drain the liquidity from the rest of the market.
And why the sudden surge in India?
Good monsoons, high government subsidies for farmers, and just a general push for food independence. They're applying more nutrients per acre.
Then you add Brazil, where imports are growing too, and then you bring it home to North America. Farmers are planting heavy here.
The USDA is projecting 93 million corn acres for 2026.
Okay.
But here's the interesting nuance. Management thinks that number is the floor.
The floor.
The industry believes it will be 93 million or even higher.
And just so everyone listening is clear on the agronomy here, corn is the nitrogen-hungry crop.
Right.
Soybeans make their own nitrogen. Corn actually needs to be fed.
Exactly. More corn acres equals more nitrogen demand, period. It's a perfectly linear relationship. If you plant corn, you must apply nitrogen, or you literally don't get a crop.
And because of that supply vacuum we just talked about, with India taking more, China exporting less, Europe shutting down.
The pricing power has shifted entirely back to the producers.
You saw that in the OLA pricing.
We did.
And OLA, for those that don't follow the granulars, is New Orleans, the benchmark pricing hub for North America. It's where the barges get loaded to go up the Mississippi.
Right. And what's the price action there?
Urea at OLA is trading at $450 per short ton. That is up $100 just since December 2025.
That is a violent move upward in a commodity in just 2 months. That's a 25 to 30% jump.
It is. It's what we call spring compression.
Right.
You have high corn prices encouraging planting. You have low fertilizer inventories in the channel because dealers were hesitant to buy in Q4.
Because they thought prices would drop, so they just waited.
The classic game of chicken.
And they lost the game of chicken.
Time.
Now, suddenly, spring is here. Everyone realizes the supply isn't there. It creates a squeeze. And CF Industries is just sitting there with the capacity to serve it.
Well, mostly sitting there. This brings us to part 2 of the deep dive, the operational headwinds. Because it wasn't all sunshine and rainbows on this call. There's a bear case lurking in the details, and it really centers on Yazoo City.
This is the operational failure that they had to address head on. In November 2025, there was an incident at their Yazoo City complex down in Mississippi.
Specifically in the ammonium nitrate plant, right?
Correct. And the damage was significant enough that the facility is down.
Completely down.
And it is not a short fix. Management guided that it won't resume production until the fourth quarter of 2026 at the earliest.
At the earliest. So that is a full year offline, basically.
Practically, yes. And that forced them to lower their 2026 gross ammonia production guidance to about 9.5 million tons.
So they are losing physical tons to sell.
They are losing tons.
And what's the financial hit from that?
They projected a roughly $200 million EBITDA drag for 2026 due strictly to this outage.
$200 million.
Yeah.
I mean, in most earnings calls, if you tell the street you're going to lose $200 million in profit due to an explosion or an incident, the stock tanks.
Instantly.
You get severely punished for operational incompetence. But CF stock went up. Why?
2 words. Business interruption. Or rather, business interruption insurance.
The silver lining.
Management confirmed they have very comprehensive insurance. They expect proceeds to start flowing in 2026 to offset those lost profits. Whoa. So while operationally it's a massive headache, financially, the net impact to the bottom line might actually be washed out completely by the insurance payout.
So the market just looked right past it.
Yeah.
They see it as a temporary insured event occurring in a high-price environment where the rest of the network is just printing money.
Precisely. And frankly, in a tight market, taking a little supply offline accidentally just tightens the market further for everyone else.
That's a good point.
It's perverse, but that's commodity economics. If you reduce supply when demand is totally inelastic, price goes up. CF sells their other tons at a higher margin.
Now, there was another operational element here that I found really fascinating, and is the invisible driver of logistics. We talked about the river earlier.
The river logistics are critical right now. We are seeing incredibly low water levels on the Mississippi.
Right.
And interestingly, the knock-on effects of winter storms up in Canada creating a massive backlog.
This connects back to that spring compression, right?
Mm-hmm.
Farmers played that game of chicken, waiting to buy.
They did. It's the just-in-time risk. Farmers and retailers delayed buying fertilizer in Q4 of 2025, hoping prices would drop. They didn't buy a thing.
Yeah.
So inventories in the field are low. Now, spring is coming. Everyone needs product at once. But the river is slow. Barges are literally stuck.
You can't just teleport fertilizer to Iowa.
Exactly.
You can't. And this is where CF's moat comes in. This is why they trade at a premium to, say, a pure importer.
This is their strategic advantage. CF has a massive distribution network inside the Corn Belt.
Right.
They have storage tanks in Iowa, in Illinois, in Indiana. They have the pipelines.
So they're already there.
While their competitors are stuck trying to push barges up a low Mississippi River, paying huge freight rates or waiting for ice to clear, CF already has the product sitting right next to the farm.
Execution is a moat. They can charge a premium because they actually have the stuff where it needs to be when the farmer needs it.
That's the geographic basis blowing out. And CF captures that entire margin. They don't have to pay the high freight to get it there today because they moved it there months ago.
So the core business is undeniably strong. But management spent a lot of time on this call talking about the future.
Yeah.
The two-engine strategy.
Right.
We have the nitrogen fertilizer engine, which is roaring. But now we have the clean energy engine.
This is the big pivot. They are trying to re-rate the company from a standard commodity chemical producer to a clean energy infrastructure play.
Which changes the multiple completely.
Completely. And the centerpiece of this is the Blue Point joint venture.
Let's unpack Blue Point. This is a massive facility down in Louisiana.
A low-carbon ammonia facility. And the key here is the partners, JERA and Mitsui.
These are Japanese giants.
Huge.
Why does that matter, though?
Yeah.
Why bring in partners? Because CF has the money to build it themselves, don't they?
They do, but it de-risks the demand. Japan is moving very aggressively to use ammonia as a fuel.
As a fuel.
Yeah, co-firing it in power plants to reduce their carbon emissions. This isn't fertilizer for corn. This is literally fuel for electricity.
Wow.
Japan has no natural gas. They have no land for solar, no wind. They need to import energy. Ammonia is how they're going to import hydrogen.
That's wild. And management confirmed a positive FID, a final investment decision, has been reached.
Right. And civil work starts in Q2 2026. This isn't just a PowerPoint slide anymore.
Yeah.
They are breaking ground. They are actually pouring concrete.
CF has a 40% interest in this. The total capex is huge, around $3.7 billion.
Yeah.
But here's the kicker. 60% of the offtake is for new demand.
That's the most important statistic. They aren't cannibalizing their fertilizer market.
Right.
This is net new demand for power generation and bunkering, which is shipping fuel, and it is backed by the Japanese government's contracts for difference.
Which guarantees a certain return profile for them.
Exactly. It makes the whole project financeable, it locks in the economics, it basically creates a firm floor for returns.
Then you have the carbon capture side, the 45Q tax credits. This is U.S. legislation.
The Donaldsonville CCS project is already running.
That's in Louisiana too, right?
Yes. They're sequestering about 1.5 million tons of CO2 in 2026. They are taking the CO2 that usually goes up into the sky and pumping it deep underground.
And the monetization here is a double dip. Explain that to us.
So first, they get the U.S. government tax credit, Section 45Q. That's for every ton of carbon they bury underground.
Okay, so guaranteed cash from Uncle Sam.
It's guaranteed cash. But then, because they have lowered the carbon intensity of the ammonia they just made, they can take that blue ammonia and sell it to customers in Europe or to industrial users at a premium price.
So they get paid by the government to bury the carbon, and then they get paid extra by the customer for the product because the carbon is buried.
It's the holy grail of industrial decarbonization. It turns a cost carbon into two separate distinct revenue streams.
That is brilliant. And they also mentioned a partnership with POE.
The ethanol producer. This is really interesting speculation for the future.
How does that work?
Using low-carbon fertilizer to grow corn actually reduces the carbon score of that corn.
Okay.
If you turn that low-carbon corn into ethanol, you get low-carbon ethanol. And low-carbon ethanol is the primary feedstock for sustainable aviation fuel, SF.
So CS is positioning itself at the very beginning of the supply chain for green jet fuel.
That is the long game. If they can own the low-carbon input, they become absolutely essential to the entire renewable fuels market.
Right.
And that deserves a much higher valuation multiple than just selling fertilizer to a farmer. A fertilizer company trades at maybe 6 times EBITDA.
Yeah.
A clean energy infrastructure company trades at 12 times or 15 times. That's the re-rating they are really chasing here.
Okay, let's look at the investor context really quick. The guidance for 2026.
They are guiding for total capex of about $1.3 billion.
How does that break down exactly?
About $550 million is just sustaining the existing network, keeping the pipes from rusting, safety checks, regular maintenance turnarounds.
Usual stuff.
But roughly $400 million is earmarked specifically for Blue Point and new growth.
And despite spending that $1.3 billion, they are still just a cash flow machine.
They reiterated their long-term target on the call, About $3 billion in mid-cycle EBITDA and roughly $2 billion in free cash flow by 2030.
And their balance sheet looks super clean. They just completed a $1 billion notes offering to refinance debt. So financial flexibility is extremely high.
Which brings us right back to the buyback math. They have $1.7 billion left on their current authorization, which doesn't expire until 2029.
And the analysis here is crucial. Do they have to choose? Like, do they have to choose between building Blue Point or buying back stock?
No. That is the beauty of the current cash flow levels. At these prices and margins, with urea at $4.50 and gas at $3, they can fund all the growth and keep buying back stock.
They can walk and chew gum at the same time. All right, before we get to our trade idea, I want to hit the Q&A lightning round. We listened to the whole Q&A so you didn't have to. There were some really sharp insights from management when they were pressed by the analysts. First up, the Brazil skepticism.
There was a pointed question about Brazil potentially restarting their idle plants. The bear case out there is that Brazil turns its domestic production back on and simply stops importing.
And management basically laughed that off.
Politely, but yes. Their argument is really simple. Rust never sleeps.
That's a great quote.
These plants are old, they are incredibly inefficient, and natural gas in Brazil is very expensive. Just because the government wants them open doesn't mean they can actually run profitably.
Rusty bolts don't turn. So the implication is Brazil stays a massive importer, completely supporting global prices.
Correct.
Next one, the China export question.
Skepticism regarding those export quotas. Management's view is that China is prioritizing domestic food security over export profits.
Like we said earlier.
Right. Even if they have the physical capacity to produce more urea, they aren't running it hard enough to flood the global market because the government is actively capping it.
Finally, CBAM, the carbon border adjustment mechanism in Europe.
Management has a very relaxed stance here. They really see it as a heads I win, tails I win situation.
Walk us through that game theory because it's important.
Scenario A, CBAM stays. European producers have to pay heavy carbon taxes. CF sends their low-carbon ammonia from Donaldsonville and sells it in Europe at a huge premium. CF wins.
Okay, and scenario B?
Scenario B, CBAM goes away. European producers lose their free carbon allowances. Their core costs go way up. CF is sitting there as the low-cost producer with cheap U.S. gas. CF wins on margin.
So no matter how the regulation shakes out, the structural energy advantage of North America keeps CF completely in the driver's seat.
Exactly. The only way CF loses is if U.S. natural gas goes to $10 or European gas drops to $3. And neither of those looks even remotely likely in 2026.
All right. We have covered the earnings, the macro, the broken plant in Yazoo, the river situation, and the Japanese energy partnership. Now it is time for the segment that our legal team hates, but you love.
This is not financial advice.
Disclaimer time. We are a deep dive discussion. We are not your financial advisors. We are not a hedge fund. This is for entertainment purposes only. Do not trade on this.
Seriously.
If you lose money, do not email us.
Please don't. But if you were a hedge fund analyst pitching to an investment committee based on only this earnings call, what is the trade?
I call this one the lumpy insurance and logistics squeeze arb. Or, if you want the flashy title, the Yazoo riverboat gamble.
Let's hear the pitch.
The trade.
Yeah.
We go long CF calendar spreads and we go short a processed food ETF.
Okay, break down the legs of this trade for us.
Leg one, the insurance lumpiness. The CFO explicitly admitted that the insurance proceeds from the Yazoo City outage will be bumpy.
Right.
Algorithms hate bumpy earnings. They hate uncertainty.
That's true. If the check doesn't clear in Q2, the headline numbers might look like a huge miss.
Exactly. So we structure a calendar spread. We bet that the market dumps the stock temporarily on a quarter where the insurance check hasn't hit the books yet, creating this massive buying opportunity.
Okay.
We use options to position for that volatility, betting on the recovery when the cash actually lands in the following quarter. Yeah. We are literally arbitraging the bureaucracy of insurance claims.
And the short side, the processed food ETF.
Leg two. The river squeeze. We are betting that the spring sprint causes a massive spike in OL barge rates and corn basis. The logistics are broken. The river is low.
So corn gets really expensive for the actual buyer.
Exactly. And who buys the corn? General Mills, Kellogg's, the food processors.
Right.
They run just-in-time supply chains too. They are about to get hit with record corn basis levels because of this logistics jam. Their input costs are going to skyrocket in Q3, just as CF is cashing its huge insurance checks.
So you are long the guy who owns the fertilizer and the storage, and you are short the guy who has to buy the super expensive corn to make flakes.
We are effectively betting that a broken piece of equipment in Mississippi causes a global repricing of cornflakes in Q3.
Wow.
It's outrageous. It's highly speculative. But the macro setup is absolutely there.
It connects the micro event, Yazoo, to the macro reality, the river logistics. It's wild, but it has a certain logic to it.
That is the Yazoo riverboat gamble. Again, do not trade this. But it shows you how all these pieces, the insurance, the rivers, the corn, the gas, how they all fit together.
It's an incredibly complex ecosystem.
So, just to recap the deep dive today, CF Industries, they beat on the top and bottom lines.
The buyback machine is running hot. 10% of the company retired in a single year.
The nitrogen market is tighter than expected because the world is short on gas and long on demand.
And the clean energy transition, Blue Point, is moving from a PowerPoint presentation to poured concrete.
It is a really compelling story. But as always, you have to do your own homework, check your own risk tolerance. The commodity cycle gives, and the commodity cycle takes away.
It certainly does, but right now the wind really seems to be at their backs.
We will see you on the next print. Thanks for listening to Talk Tickers.
Goodbye.